Most traders focus only on candles. They see green and red bars moving up and down. They draw patterns. They mark support and resistance. But they ignore the single most important layer of information on the entire chart. Price is the advertisement, volume is the transaction. Judging a chart without volume is like judging a restaurant by its sign without checking whether anyone is eating inside. The sign might look impressive, but if the tables are empty, something is wrong. In this video, we are not just going to define volume, we are going to understand what it means. Because once you truly understand volume, every candle on your chart starts telling a story. And volume becomes the proof behind that story. Let's start with something simple. Every chart speaks two languages at the same time. The first language is price. Price tells you what happened. Did the market move up? Down? The second language is volume. Volume tells you how much conviction was behind that move. How much participation was there? How much money actually changed hands? Think of it like an election. Price is the result, who won. Volume is the number of voters who showed up. If only 10 people voted, does the result mean much? Probably not. But if 10 million people voted, that result carries weight. The same logic applies to the market. A large green candle with low volume, that's questionable. A large green candle with strong volume, that's conviction. From now on, don't just ask, where did price go? Ask, how much money supported that move? Now here's the most important concept in this entire lesson. To read volume correctly, you only need one mental model: effort versus result. In the market, effort is volume, the energy, the money, the participation. Result is the candle, how far price actually moved. Imagine pushing a car uphill. Pressing the gas pedal is effort. How far the car moves is the result. Case 1, you press the gas, and the car moves smoothly uphill. Effort matches result. That's healthy. On a chart, this looks like a large candle supported by strong volume. Buyers are committed. The move is real. Case 2, you press the gas hard. The engine roars. Fuel burns. But the car barely moves. Something is blocking it. On the chart, this appears as a small candle sitting above extremely high volume. This is called absorption. Buyers are pushing aggressively. But a large seller, often institutional money, is absorbing every buy order. They are quietly selling into that demand. Think of a dam holding back water. The water keeps flowing in, but the wall does not break. Eventually, the water pressure fades, and when buyers are exhausted, price often drops sharply. High effort, small result, that's a warning. Case 3, you barely touch the gas and the car keeps rolling uphill. There's no resistance. On the chart, that's price rising on low volume. This is known as no supply. It doesn't mean buyers are strong. It means sellers are absent. Nobody is standing in the way. Now memorize this quick matrix. High volume plus big candle equals healthy move. High volume plus price moving equals lack of opposition. Low volume plus price moving equals lack of opposition. That's your foundation. Now let's apply effort versus result to real patterns. First pattern, stopping volume. Imagine price is crashing, red candle after red candle, panic selling everywhere. Then suddenly, you see a large red candle with extremely high volume. But instead of closing at the very bottom, it forms a long lower wick and closes near the middle. What happened? Someone with serious capital stepped in and absorbed the selling pressure. High effort, limited downside result. That is often a sign of accumulation, a potential bottom forming. Second pattern, buying climax. Now imagine price has been rising for weeks. News is positive. Retail traders are excited. Then a massive green candle appears with the highest volume on the chart. Most traders see strength. But smart money often uses these emotional moments to distribute their positions. They sell into the surge of retail buying. The busiest moment in a market is often when large players are exiting. A buying climax is not strength. It is often the final push before reversal. Third pattern, no supply test. After an uptrend, price pulls back slightly. A small red candle forms, but volume is very low. The market is asking, does anyone want to sell here? Low volume answers, no. That absence of selling pressure often allows the uptrend to continue. Three patterns. One model, effort versus result. That's enough to understand the majority of volume behavior on any chart. But before we go further, we need to correct a common misconception. Many traders believe green volume means buying and red volume means selling. Every trade requires both a buyer and a seller. Volume measures activity, not dominance. The color of the volume bar simply matches the candle color. It does not reveal who is in control. To understand control, look at size and close location. That's where the real story is. Now that you understand effort versus result, let's talk about one of the most powerful warning signals in volume analysis: volume divergence. When price and volume move together, the trend is heya, L-phi-A. If price is rising and volume is increasing, buyers are committed, the move has fuel. If price is falling and volume is increasing, sellers are aggressive. The move has strength, but when price and volume begin to disagree, that's when you need to pay attention. Imagine price making new highs. The chart looks strong. Breakouts are happening. Retail traders are celebrating. But when you look at the volume bars, something is different. They're shrinking. Each new high comes with less participation than the previous one. That's divergence. Think of a rocket launching into the sky. At liftoff, fuel is full. The engines roar. Thrust is powerful. But as the fuel burns, power decreases. Eventually, gravity wins. When price rises but volume declines, the move is running out of fuel. Fewer traders believe in it. Fewer buyers are participating. The trend is getting tired. That doesn't mean it will reverse immediately, but it means momentum is weakening. The same logic works in reverse. If price is falling but volume is decreasing as well, sellers are losing conviction. Each new drop has less participation. The selling pressure is drying up. That's often how bottoms form, not with explosive buying, but with exhaustion. Volume divergence is your early warning system. The market may still be moving, but participation is fading. Now let's turn everything you've learned into a practical method you can apply immediately. I call it the 3-step volume check. Step 1, zoom out. Before analyzing individual candles, zoom out to a higher time frame, daily or weekly. Ask yourself, is overall volume increasing or decreasing or decreasing? Are there recent unusual spikes? Is participation expanding or contracting? Think of it like checking the climate before checking the weather. You need context before. Read details. If overall volume has been declining during an uptrend, you already know the move may be losing strength. If volume is expanding during a breakout, you know interest is increasing. Context changes interpretation. Step 2, zoom in to key levels. Now move to your trading time frame and identify major support and resistance levels. Volume matters most at important levels. When price approaches resistance, observe effort versus result. If volume spikes but the candle remains small, absorption may be happening. Buyers are pushing, but a wall of selling is absorbing the pressure. That's a warning. If price breaks resistance with a large candle supported by strong volume, that's effort matching result. That's conviction. But if price breaks resistance on low volume, be cautious. Breakouts without participation often fail. The same applies at support levels. If price drops into support with massive volume but fails to continue lower, that could be stopping volume. Smart money accumulating. Volume gives meaning to structure. Step 3, wait for confirmation. This is where most traders make mistakes. They see one strong candle and immediately enter. Don't. After a breakout, wait for the next candle. Does price pull back to the broken level? If it does, observe the volume. If that pullback happens on low volume, that's often a no supply test. The market is checking for sellers and finding none. That confirmation is far more reliable than the initial breakout candle. Patience for one extra candle can eliminate a large percentage of false entries. Now let's summarize this into a quick checklist you can use before any trade. 1, is volume expanding or contracting compared to recent bars? 2, does effort match result? Large volume should create meaningful movement. Is there absorption at key levels? High volume but limited movement is a warning. 4, is there divergence? New highs on declining volume signal weakness. Fixed. USC set divergence. U highs on declining volume signal weakness. 5, has the next candle confirmed the move? If you ask these 5 questions consistently, you are no longer guessing. You are reading participation. And participation is the real story behind every move. Here is something important to understand. Price can be manipulated in the short term. Stop hunts happen. False breakouts happen. But volume shows you where real money is committing. It reveals where conviction exists and where it doesn't. When you combine price structure with volume analysis, you stop reacting to noise and start interpreting intent. That is the shift. Volume is not just another indicator, it is evidence. Without it, you are reading headlines without facts. With it, you are reading the entire story. From now on, when you open a chart, don't just look at candles. Ask yourself, who is participating here? Is this move supported? Is this move exhausted? Is someone absorbing? Is someone stepping aside? When you begin asking those questions, your chart changes. The market becomes less random, less emotional, more structured. Not because the market changed, but because you did. And that is where better decisions begin. Now that you understand effort versus result, let's go deeper into one of the most powerful signals volume gives you: volume divergence. This is where traders who truly understand the market begin to separate themselves from everyone else. When price and volume move together, trends are healthy. If price is rising and volume is increasing, buyers are participating. The move has support. It has energy behind it. If price is falling and volume is increasing, sell. RERS are committed. That move has strength too. But when price and volume begin to disagree, that's when the market starts whispering. And most traders never hear it. Imagine price making new highs. The chart looks clean. Breakouts are forming. Social media is excited. Traders are posting profits. But underneath the surface, something subtle is changing. Each new high is forming on lower volume than the previous one. Participation is shrinking. Conviction is fading. That is divergence. Think of it like a rocket launch. At liftoff, the engines fire with full thrust. Massive power, massive fuel consumption. The rocket climbs quickly, but as fuel burns, thrust decreases. The rocket still moves upward, but the power behind it is weakening. Eventually, gravity wins. When price makes higher highs but volume makes lower highs, the trend is losing fuel. It doesn't mean price will immediately reverse. Markets can drift higher on declining volume for a while, but it does mean the move is becoming fragile. Fewer traders are participating. Fewer traders believe. And when participation dries up, even a small wave of selling can trigger a larger reversal. Now flip the scenario. Price is falling. Lower lows are forming. The trend looks bearish, but volume is declining with each new low. The selling pressure is weakening. This is not aggressive selling anymore. This is exhaustion. That's often how bottoms form, not with explosive buying, but with the absence of sellers. The market doesn't need massive demand to rise. It only needs selling to stop. Volume divergence is your early warning system. It tells you when a move is running out of energy before price actually turns. Most traders wait for price confirmation. Volume gives you early context. Now let's build a structured process around and everything you've learned. Because knowledge without process creates confusion. I call this the 3-step volume framework. Step 1, zoom out. Before analyzing individual candles, zoom out to the higher time frame, daily, weekly, even monthly depending on your style. Ask yourself, is overall volume expanding or contracting over the past several weeks? Are there unusual spikes that stand out from the rest? Is participation increasing during trends or decreasing? Context matters more than individual candles. If an uptrend is forming on steadily increasing volume, that trend is healthy. If an uptrend continues while volume steadily declines, it may be fragile. Zooming out gives you perspective. It prevents you from reacting emotionally to small moves inside a larger structure. Step 2. Focus on key levels. Volume matters most at important levels. Support, resistance, breakouts, breakdowns. Price approaching a key level is where intent reveals itself. Imagine price reaching a strong resistance level. If volume spikes dramatically but price barely moves, that is absorption. Buyers are pushing, sellers are absorbing. Effort is high, result is limited. That's not strength, that's friction. Now imagine price breaks through resistance with a wide candle and high volume. Effort matches result, participation confirms the breakout. That's conviction. But if price breaks resistance on low volume, that breakout lacks support. Breakouts without participation often fail because they lack real commitment. The same applies at support levels. If price crashes into support with huge volume but cannot continue lower, that may be stopping volume. Smart money absorbing panic selling. Volume gives meaning to structure. Structure alone is incomplete. Step 3. Wait for confirmation. This is where discipline separates professionals from amateurs. Most traders see a breakout and enter immediately. Professionals wait. After a breakout, observe the next candle. Does price pull back toward the broken level? If it does, what does volume look like? If the pullback occurs on low volume, that's often a no supply test. The market is checking if sellers exist at the broken level. If volume is low, sellers are absent. That confirmation strengthens the breakout. But if the pullback happens on high volume and price struggles to hold above the level, that breakout may fail. Waiting one extra candle can dramatically increase your probability. Volume is not about speed, it's about clarity. Now let's talk about something most traders misunderstand. Volume spikes. Not all high volume is bullish. Not all high volume is bearish. High volume means activity, but activity alone doesn't tell you direction. You must always combine volume with candle structure. Large volume with strong follow-through suggests conviction. Large volume with small range suggests absorption. Large volume at the top of a trend often suggests distribution. Large volume at the bottom often suggests accumulation. Volume is context dependent. This is why effort versus result is so powerful. It simplifies everything. Now here's a practical checklist you can apply before every trade. 1. Is volume expanding or contracting relative to recent bars?
2. Does the size of the candle match the size of the volume? 3. Is volume confirming the breakout or contradicting it? 4. Is divergence forming between price and participation? 5. Has the next candle confirmed the move?
If you consistently ask these questions, your trading decisions become evidence-based, not emotional, not reactive, evidence-based. Now, let's address something important. Volume does not predict the future. It reveals behavior, and behavior repeats. When institutions accumulate, volume increases. When institutions distribute, volume increases. When retail traders panic, volume increases. When markets are uncertain, volume decreases. When markets are uncertain, volume decreases. Volume reflects participation psychology. It reflects commitment. It reflects urgency, because urgency creates imbalance, and imbalance creates opportunity. Here's the shift that changes everything. Most traders focus only on price patterns. They look for triangles, flags, breakouts, head, and shoulders, but patterns without participation are empty. A breakout without volume is just a shape. A breakout with volume is intent. Volume transforms patterns into information. Now think about this. If price rises on low volume, it doesn't mean buyers are strong. It means sellers are absent. That distinction matters. Markets move because of imbalance. Either buyers are aggressive or sellers step aside. Volume tells you which one is happening, and that changes how you interpret trends. Finally, remember this. Price can be manipulated in the short term. Stops can be hunted. False breakouts can occur, but sustained moves require participation. They require volume. Real trends are built on commitment. Volume is the truth behind the candle. From now on, when you open a chart, don't just ask, where did price go? Ask who showed up. Was this move supported? Is this move running out of energy? Is someone absorbing? Is participation increasing or fading? Is participation increasing or fading? When you start asking these questions, your trading becomes analytical. Volume shifts you from reacting to interpreting. And interpretation is where consistency begins. You on it need dozens of indicators. You don't need complex formulas. You need context. You need effort versus result. You need participation confirmation. That's it. Volume doesn't make trading easier. It makes it clearer. And clarity reduces impulsive decisions. Clarity builds discipline, and discipline builds longevity. Master volume, and you stop chasing candles. You start reading behavior. And behavior is the foundation of every market move. Now that you understand divergence, absorption, and confirmation, let's take this one step further. Because volume is not just about patterns, it's about psychology. Behind every volume bar is human behavior: fear, greed, urgency, hesitation, confidence, exhaustion. Volume is emotional intensity measured in transactions. And once you understand that, charts stop being abstract. They become human. Let's talk about emotional extremes. The market tends to turn when emotion reaches a peak, not when it is quiet, not when it is quiet, not when it is calm. When it is extreme, and extremes show up in volume. Think about a strong uptrend. Price keeps rising. Traders feel confident. Profits are growing. Optimism spreads. Then suddenly, a massive green candle appears. The volume underneath it is the largest in weeks. Retail traders see that and think, this is the breakout. This is strength. I can't miss this. But often, that extreme volume at the top is distribution. It's the moment when late buyers rush in and professionals quietly sell into that demand. The public buys emotionally. Professionals sell strategically, and the only clue you get is extreme volume at the end of a move. Now reverse the scenario. Price has been falling for days. News is negative. Fear is everywhere. Then you see a huge red candle with massive volume. Retail traders panic and sell at market. But the candle doesn't close at the low. It leaves a lower wick. That can be accumulation. Professionals stepping in quietly, absorbing panic. Volume reveals emotional extremes, and emotional extremes often signal turning points.